Hey everyone, in this video we're going to be going over Warner Bros. Discovery stock, ticker WBD. This is one of the stocks commented in my last video by a subscriber looking to get an in-depth review on WBD. If you want to get an in-depth review on any stock, definitely comment it below this video for any future videos I make. If you're not subscribed yet, definitely subscribe, and if you haven't liked this video yet, please like the video. It definitely helps the YouTube algorithm and helps the channel. Now let's get into it. Now, looking at the stock price at $10.77, down 57.76% in the past year, it's no wonder any investor would like to get an understanding of, does it deserve to be down this much, or is this an amazing opportunity to buy this stock? And we're going to try to answer that by doing a deep dive in their most recent earnings report, get into some of the fundamentals and why it's valued where it is or why it should be valued higher, and kind of break it all down so that it's easy to understand for everyone. So we're going to first look at their most recent earnings report, which was their third quarter 2022 earnings release. It was November 3rd, 2022. So earlier this month, they had their third quarter as a new company, Warner Bros. Discovery. The merger happens not too long ago. And since AT&T took Warner Bros. And merged it basically with Discovery, this new company that's really just a pure content play company, a lot of people are wondering, what are they going to do with it? What are the numbers going to look like? What are the synergies of Discovery merging with Warner Bros? And that's why they start off just basically talking about the synergies. And they're saying they're raising their total synergy target to $3.5 billion plus by 2024 plus, which means it could be a little after that as well. And there's incremental synergies of having these companies together, and there's captured synergies, they're calling it. But basically synergies of having two companies that do kind of the same business coming together rather than performing separately. Now, one of their departments, studios, had revenue drop year over year. So third quarter 2021, it was $3.35 billion for Warner Bros. And Discovery kind of together. And then this quarter, $3 billion, $3.088 billion. Now, the pro forma adjusted EBITDA is up 43% from $556 million to $762 million. And they're basically saying the reason for that increase is because the operating expenses decreased. They saw things like marketing spend and content expenses basically come down since there wasn't as much revenue, there wasn't as much releases in the quarter, etc. Now, networks is another thing that they break down, and their revenue in the networks department in this quarter is $5.214 billion. This is also down. It's down 8% year over year from $5.87 billion. And the EBITDA is down 2% to $2.63 billion from $2.7 billion. So there are some downward trends. That's not great to see, but they give you reasons, with the macro environment, et cetera, things like that. Now, DTC, arguably the most important part of their future. Their revenue in DTC this quarter versus a year ago is down 6%. So I don't like to see that at all. It was $2.497 billion 3Q21. It's now $2.317 billion 3Q22. And that's year over year, not quarter to quarter. So in my opinion, year over year, that number should have definitely got higher. But there's reasons they're doing a merger and going to change up their DTC strategy going forward. So we'll get into that a little deeper as well. Now, as far as adjusted EBITDA, it's down to a loss of $634 million this quarter from a loss of $309 million. So that's obviously a bigger loss. That said, it's not surprising to see big losses going on as they're putting more and more content on these services. And on the bottom right of the screen, I'm showing their DTC subscribers. So just to get an idea, domestically, their total subscriber count at the end of this quarter is 53.5 million, with an ARPU domestically, average revenue per user of $10.66. As far as international total subscribers, they have 41.4 million, with an ARPU internationally of $3.68. The ARPU domestically did go up slightly from $10.54 to $10.66 a quarter ago. The international ARPU remained basically flat. And total DTC subscribers at 94.9 million. This is up quarter over quarter. So Q2 was 92.1 million, and a year ago, Q3, same quarter, 2021, 79.9 million total subs. And the final number to look at was the global ARPU, average revenue per user, at $7.52, slightly down from $7.66 last quarter. So overall, we're basically seeing kind of declines year over year across the board. So revenue from 10.98 billion dropping to this quarter 9.8 billion, the year over year comparison. Adjusted EBITDA being 2.668 billion down to 2.424 billion, and reported free cash flow being positive 705 million to a loss of 192 million this quarter. Now, that's not great, any of that, but this is a lot worse. And this is probably the main reason that a lot of people don't own this stock. And it's clearly their massive amount of debt versus cash. So they have a net debt of $47.9 billion. And what that's saying is they basically have $50.4 billion of debt, but they have $2.5 billion of cash. So when you take the cash away from the debt, well, they have 47.9 billion in debt, basically. That is a lot of debt, a ton of debt. Now, they break down some of this debt to show, all right, well, it's not all going to be due immediately. 25% of it is due in less than 3 years, and then 11% more will be due between 3 and 5 years from now. 21% due in 5 to 10 years from now, and the final 43% due in over 10 years from now. So they're saying, the average maturity of 14 plus years on their debt, and they're also basically saying that their average cost of the debt is only 4.3%. I do say only, but it's a huge amount since it's a large dollar amount. That adds up quick. Now, they give us some outlook, which is really important for analysts to get this from the company to understand at least what they're thinking and what they're seeing. So for 2022, they reiterated that adjusted EBITDA of 9 to 9.5 billion and reported free cash flow of around 3 billion after costs to achieve synergies. They go into 2023 to say there's some tailwinds, a $2 billion incremental synergy capture, full year impact of course correction actions that they have been doing, like getting rid of CNN Plus, etc. And then their direct-to-consumer relaunch in the US and Latin America, because they're going to be relaunching that service, with Discovery all bundled in together, I guess. And then there's some uncertainties, of course, so macroeconomics, geopolitical, secular, pay TV ecosystems, FX impacts, things like that. But ideally, 2023, they're working towards, they say, adjusted EBITDA of 12 billion, and then a reported free cash flow of somewhere between 33 to 50% of that $12 billion. So we can use those numbers to try to get an idea of what this company should be worth, at least now to the near-term future, 2023, and then we can look beyond that. So first, I just want to say don't make a mistake by looking at their market cap for the true value of this company. The market cap is what the company's worth when you're looking at the share price times the amount of outstanding shares. But the market cap doesn't include cash or debt from the company, and clearly there's a ton of debt in this company. So this can be a little misleading for new investors looking at it and saying, oh, well, Warner Bros. Discovery is only 26.5 or 26.15 billion, and they're expecting to do $12 billion of adjusted EBITDA, and 50% of that is possible free cash flow. What a great return. Well, first, we need to just take into account debt, and that's what enterprise value does. So if you look at Warner Bros. Discovery market cap, 26.15 billion, you look at their enterprise value, it's actually 73.6 billion. So clearly a massive difference, and that's because enterprise value includes the extra cash and the debt to show what you're actually paying for, what the real value of that company is on a per share basis. Basically, when you're buying these shares, you want to know, including the debt or including if they had a huge cash balance, then that should come off market cap because you're getting that as well by owning a piece of that company. So let's look again. Most recent earnings, net income, because net income's pretty important. Net income came out as a loss of $2.3 billion for just this quarter. Their adjusted EBITDA showed a positive $2.4 billion, but clearly, that's because in adjusted EBITDA, it's earnings before interest, tax, depreciation, amortization. Well, interest on a $50 billion debt that you owe is a huge amount. So that is clearly not the best way to value this company, is not looking at their EBITDA. It really should be looking at their net income, because you have to keep in mind that they do have this debt. And free cash flow also doesn't include interest payments, but they are showing free cash flow of a loss of 192 million. So, how to value them if they're losing money? Well, we can do a few things. This probably seems the most reasonable way for me to value them for now, even though, even at this valuation we're going to do, it's still a little tricky because of all this debt. So, first, you can take their guidance of 2023 adjusted EBITDA of 12 billion, because they give us that number. And they're expecting 33 to 50% conversion into free cash flow. Well, we can do a multiple on the free cash flow at least. So we take their range. 33% of 12 billion is 3.96 billion, and 50% of 12 billion is 6 billion. So they are expecting 3.96 billion to $6 billion of free cash flow in 2023, next year. Well, what's a reasonable multiple on that free cash flow to pay? Well, they are giving us quite a range. 4 to 6 billion of free cash flow is a 50% difference from the low to the high. From 4 billion to 6, it's an extra 50%, an extra $2 billion of free cash flow. So let's give them a higher multiple on the low end and a lower multiple on the high end, just to be a little safe. So if we say 20 times the low end or 10 times the high end, that gets you 20 times 3.96 billion is 79.2 billion, and 10 times the 6 billion is 60 billion. So, between 60 to 80 billion, we call it 70 billion. And sure enough, if you look at their current enterprise value, it's 73.6 billion. So based on the current commentary from management, the guidance for 2023, the market has correctly, in my opinion, valued Warner Brothers Discovery at just under $11 a share, or basically $70 billion in enterprise value. Now, we could take a longer outlook approach to find value as well, but that is a lot more guessing rather than going off of actual numbers that the management's giving us. And I'll give you an example on how we could do that. So, taking the long view, discount cash flow models, things like that, with numbers that you basically plug in based on your own opinions on where things might go. So, the market's short sighted most of the time. Usually, the market will value a stock based on its current or near future expectations. And they're trying to see what the next 3 months look like, maybe the next year. But beyond that, a lot of analysts just can't risk being wrong, because making predictions that are wrong for the long term could get them fired and they could lose their jobs. So they try to do calculations on near-term projections that are a lot easier to predict than long-term ones. But as an individual investor that's willing to wait for the long-term thesis to play out, you can value the company a little differently than the typical analyst would. The only thing is, if you're wrong, you could be in for a world of pain. And my favorite companies look good on a short-term basis, but also have that special something that makes them a really good long-term play that most analysts will overlook that long-term prospect in that company. So bringing this to Warner Bros. Discovery, here's a way that we can basically decide on, a long-term view that could or could not play out. We could say Warner Bros. Discovery is a major production house. It has brands like HBO, Warner Bros., DC, Discovery, big movie franchises like Harry Potter, shows like Game of Thrones. It's easy to believe that they'll be a major player in streaming long-term if they make incredible content and they only let you access that content on their DTC services. So if you believe they can eventually get from just under 100 million subs today to 250 to 500 million subs by 2030, if you believe they can go from charging today around $7.52 average revenue per user globally to 15 to 20 bucks of an average revenue per user by 2030, well, then you could see revenue from DTC get from the low end of those assumptions being $45 billion of revenue from DTC annually, to the high end of those assumptions being $120 billion of annual revenue by 2030, of course, not anytime soon, but for the longer future prospects. And with a content budget today of $23 billion, if we move that up to $30 billion by 2030, you could see anywhere from $15 to $90 billion of gross profit on the direct-to-consumer business. Now, that's obviously a wide range, and it's basing it off of a kind of wide spectrum of ARPU and total subscriber count. Now, this is something that might not ever happen, but if it does happen, then the numbers don't lie. You put a 10 times multiple, that's a cheap multiple, in the middle point of those numbers, let's say 37.5 bill, well, that would bring you to $375 billion company. So at $375 billion versus the $75 billion enterprise value today, that potential move between now and 2030, even with that many years ahead, it's still a massive, massive gain. Would be a huge win, clearly. And that would give you a reason to buy Warner Bros. Discovery at today's price without worrying about, near term issues that they're working through. So it's easy to overlook those conditions in the near term when you're investing with these long term theses in mind. So if you're right, you can make a fortune. And if you're wrong, it can be extremely painful. Personally, I do believe in this direct to consumer long term thesis. And I think Warner Bros. Discovery does have a chance of making people a lot of money by being one of the long term winners. That said, I personally believe that Disney, ticker DIS, has an easier opportunity to achieve that long term goal. And I also prefer to own Disney's assets over Warner Bros. Discovery's, especially if this thesis doesn't work out. So, linear networks, they're continuing to decline. We all know that. And DTC is going to continue to grow. We expect that as well. And the question I ask is, what is Warner Bros. Discovery? What is Disney at its core? And the answer is they're both companies that tell stories, that make content. You then need to ask, well, which company makes and tells better stories, and which company is better at monetizing the content that they produce? Now, when it comes to which company makes better stories, that's obviously very subjective, and everyone's going to have their own opinion on which company does it better. Personally, I believe they both make incredible content, but I do think Disney has a little bit of an edge with the brands they own, especially after the Fox acquisition. They own 21st Century Fox, they own FX, they own Hulu, Disney, Pixar, Marvel, National Geographic, Lucasfilm, etc. It's really hard to beat the brands they own. But the more important question then, which one makes better stories, is which company is able to monetize the stories that they do make better than the other. Now, DTC is just one way the content is being monetized. Now, it's obviously the largest way. People paying a subscription to watch the content itself is going to be the largest way it's monetized. But Disney also takes that content and it brings it to their parks, the content that really, sparks interest and people love. They can test which content people are going to love on the DTC platform. And once something hits and is a big win, they then take it to their parks, their cruises, their hotels, the merchandise, etc. That flywheel is unmatchable. Yes, Warner Bros. Discoveries can take their their big winning content and do merchandise and things like that, but they don't have the cruise ships, the parks. They can partner with others, but it's not in-house where they can really optimize making the most amount of money from a piece of content the way Disney can. So for me, Warner Bros. Discovery, after falling 57%, is pretty fairly priced for the near-term future. If you like the brands they own, you want to buy the company, and you want to hold on to it, then in my opinion, it's kind of a hold. I wouldn't say it's a buy. And the reason that I don't put a buy on it at today's price is strictly because of that debt. I think they could get things right, and you could make a huge return if they do get a handle on the debt and really, start to see that debt come down and profits go up. And if they're winning DTC in any way or form, that could be huge. But I just cannot recommend buying a company with $2.5 billion of cash on hand and a 48 billion or 50 billion, whatever it was, of debt, 48 billion net after the cash. That's just the biggest crutch holding this company down. And personally, I think there's a better opportunity in Disney for the short and the long-term opportunities. So I wouldn't own Warner Bros. Discovery right now. I don't own it currently. And I'd rather put my capital that I designate towards my direct-to-consumer play / entertainment in Disney over Warner Bros. Discovery. Now, thank you so much for watching. If you got to this point, please like this video. Comment below any stock you want me to do a breakdown similar to this one on. Just comment the name, the ticker, and I'll be happy to do a breakdown. Make sure you're subscribed if you're not subscribed. And until next time.